Hey, I'm Sean Russell. I'm the Cowtownbanker. I'm going to talk about loans more in a general sense in financing. So again, if you are lucky enough to have the challenge of either paying cash or financing, and you choose to finance or you need to finance, which is more my corner of the economic world and food chain, then I'm going to be talking to you about the options. Generally speaking, the banks that finance, there's a lot of misinformation, let me just start by saying, out there, because these are not vanilla loans. These are not like FHA loans. These are not backed by the federal government or conventional standards. There's some parts of it that we follow those guidelines, or different banks follow at different levels. But generally speaking, what banks are trying to do, and what our bank tries to do, is we're trying to eliminate redundant closings. If you can imagine a situation where someone comes along, they find a piece of land. Well, you got to buy it, you got to close it. Every closing means an attorney and attorney settlement fees. Then you go to the next phase and you're ready to do construction. So you pull what's called an interim construction loan, let's say. There's closing fees of that because there's an attorney. Then when you're done with construction, how do you land on a regular 30-year fixed loan, or a conventional, or a VA loan, or whatever you might be interested in for the long term, or a jumbo loan? That would be 3 closings, and you can very quickly jump up to $20,000 in closing costs on your average custom home. So when banks are competing for these loans, the general idea of all of us, we all have different ways where we are combining those closing costs and trying to reduce or eliminate redundant closing costs. The way that we do that is with two main simple programs. One is called a one-time close. The idea being, if I can close and come up with a way to buy the land, finance the construction, or set aside the construction money, and then to have a permanent loan solution on the end of it, or options for a permanent loan, then that's going to be my most cost-effective way forward typically. A one-time close also has the advantage of locking in rates up front. In most cases, they have some sort of permanent end, so that in the event where rates are going up, then it can help to protect you against future risk. So, but again, remember, these are not conventional rates, so they're going to run higher. They're not federally backed loans. In fact, for the banks that carry them, there's some penalties associated with it, So typically these loans are best served or best handled by your local community bank. I'm in Texas again. I work around the Fort Worth area. I can work pretty much anywhere in the state and in Oklahoma, but that's about it for our footprint. You need to have a network. Banks need to have a network of appraisers and inspectors to keep the project moving for you, because as I'll say many times, time is always the enemy. So things need to move fast. We need inspectors out fast to protect your budget, to protect your loan. So again, basic categories: one-time, two-time close. There's different ways that banks may incentivize, like our bank offers. If you're doing a two-time close right now the rates are a little bit better, and I'm videoing this right now in February of 2025. It changes, and it doesn't really have to do with as much with the local market as it might with our bank, for instance. So for most of my career, I've done mostly one-time close loans. That's made sense for most people. Rates are coming down right now, so people are looking at two-time close options to maybe save a little on interest and save a little bit on fees. What happens on the one-time close, again, you close one time, you get a few documents notarized at the end and kind of settle up your interest. Small fee of about $450, $500. It really just covers some legal recording costs with the county. But then the loan gets changed from a construction loan, which might have rates in the high 7s, to a conventional loan or a VA loan, or if you're a veteran, where rates might be in the mid to low 6s and heading down into the 5s, which is where, God help us, I hope we can arrive at within the next year. So the important thing to note is that most construction loans, if you're looking at an environment like we are right now where rates are going to drop, then it's to your advantage to not lock in those rates long term. So that's kind of the direction we're leaning. Again, this is as of February of 2025 that I'm recording this. When you do a two-time close, or when you do a one-time close, banks have different down payment requirements. You can use the equity in your land with most banks. Our bank, for instance, only requires 5% equity in the project. So if you were going to, let's say, a neighborhood where custom builders might already own the lot, and then if you like that lot, you're going to build with that particular builder. One thing I'll say is that in those situations are usually the most cost-effective overall. You can put 5% down. You can do literally one closing, buy the lot from the builder or the developer, and simultaneously fund construction. and then have a permanent loan solution at the end, again, with just one closing, one set of fees, which is really nice. When you are building in these neighborhoods, a couple things to know. Banks have different ways of verifying, but generally we're looking for, in Texas, for instance, you don't have to have a license. So we are looking at your builders. And let me just say, I can't always tell you what I might see, but if a builder is in financial trouble, we will know. Even if it's not necessarily on our project, there's ways that we can find out if that builder's got some problems with money. Because as soon as the important thing to us is save you on fees as a customer, but also it is in our mutual interest, as you can imagine, as a bank. If we're lending $500,000 or $1 million on a project, we want to make dang sure that that house can get finished for the budget. So we vet our builders. It's important that you understand how your builder's been vetted. We are looking, again, for public record information. We're looking for stuff where we might see liens get filed by trades and stuff on a project, even if it's another project, because, again, you don't want to work with a builder that's got money problems already going into it. And if they have liens filed, that could stop money or cause lawsuit issues. It can tie up the property and different things that you don't want to get messed with. So that's another way that we protect you. A third way that we protect you in this construction project or with these programs is we'll add in a contingency budget. So let's say you're all in price with your builder with $600,000 and the build was $500,000. We're going to have you build in at least a 5% contingency to 10% contingency. Now, the difference is going to be whether you have a fixed cost or a cost plus contract. Let me say about both of these that neither one of them is a guarantee from the builder that they are going to be able to control the pricing on every single item that you may pick along the way. Whether it's a fixed cost or a cost plus contract, it is important that you discuss with your lender and your builder how they handle what is called a material cost escalation or a material escalation clause. What is the percentage? What does that look like? If there's a tariff on lumber that all of a sudden hits and all of a sudden there's a lumber shortage like there was probably about 5 years ago, how do they handle that? How do they mitigate that risk? How do you mitigate that risk? And some of the things that we may do. So if it's a fixed cost contract, we're going to have you add in 5% to the budget. If it's a cost plus contract, which generally means that the builder has a baseline, based on the last houses that they have built. They kind of sit with you and they figure you like a certain type of, grade of flooring, appliance packages, lighting packages, fixtures, things like that. Once they talk to you about what that might look like, they're going to give you a package that should cover that or create at least a baseline of coverage for that. But by its nature, cost plus deals is going to typically lay out more cash. To give you an idea, let's say it was $1 million cost plus deal. And it is usually on the higher end $1 million projects and above where I might see a cost plus deal more typically, because there's a longer build process and a builder cannot guarantee, if he's building 10 or 12 houses a year, he can't guarantee the cabinets that you priced out 12 months ago are still going to hold when it's time to order those cabinets or windows or other things. So just understand that. My average customer on a cost plus deal is using, if we set aside a 10% contingency budget, so that's on $1 million build, that's $100,000. We're going to have you either set aside an account or build into the budget to protect yourself so that you have money accessible immediately upon the needs of that project so that you can approve those draws and keep the project moving and not have any nasty surprises at the end of construction. We'll talk about that. We'll go back to cost overruns and things like that. Again, very important subject to talk about with your builder as well, how he communicates those things. But as you're going through and you're building your house, you have a baseline budget. You are approving every draw for that house. So when the foundation is poured, the builder puts in the requests, we're sending out an inspector, and you simultaneously are approving the draw. You have the ability to hold things up if you want to get an independent inspection, or you want to go out and at least get to see it yourself before you approve the draw. You have control over the budget. You are not handing the builder a check for an amount of money the way it is when you buy a house from an individual or an existing house. You are simply agreeing to a budget, okay, that you're going to work off of, and that builder and you have come to the agreement that X amount of dollars have got to be proven available and accessible or in the builder retained funds category before we start and we break ground. Sometimes there'll be also what's called a commencement clause, which is good for a builder to collect. It keeps their cash flow positive so that they are constantly ahead and able to order stuff further out without overly straining their own finances to order the things you want. The earlier that builder is able to order your project needs, your supplies and your material costs, the better for you. Again, time is the enemy. So the later, if they wait in the game because they got to get ahead on this budget because they started behind, that doesn't serve you any purposes, any benefit. It is good for the builder to collect a commencement fee or a soft cost draw at closing, where they might recoup some of the money they've already spent and collect the money that they're going to need for deposits for everything from windows to bricks, whatever might come up short. They want to order quickly. So again, fixed costs, cost plus, it's important that you understand those differences and how your builder views it, how your builder goes about notifying you of change orders. So for instance, this is what it looks like. You've got a $12,000 flooring budget, let's say, for your house. Now you're 3 months into the build, 4 months into the build, you're out making your selections. And the wood flooring that you want is actually going to cost $13,000. So the builder verifies that price. He's going to let you know that that's the price. You're going to approve the draw. If he's smart, he does it in writing in a way that you can track it. And then when he goes to request the draw for $13,000, you have to approve not only the $12,000 that was allotted, but $1,000 of that contingency money. The contingency money is not just readily available. Again, there are no blank checks here. You have total control over this process. If you don't use the money, you don't pay interest. But it is important that you have it readily available to quickly fund those projects. And then as you go through as you're going through and you're completing items, let's say you came in under, your flooring was $11,000 instead of $12,000. That money carries down into the contingency line and you can reallocate that money for whatever you want. So landscaping budget, I'll just say a lot of outdoor kitchens and a lot of TVs get upgraded towards the end of my builds. So you can reallocate that money if you want to, but again, if you don't use it, you don't pay interest. And what you carry forward into the permanent phase, whether it's into a conventional loan, a VA loan, or some sort of jumbo product, is only based on what you actually use. Okay, so to recap, the big picture is when you're financing a house, banks are trying to eliminate or reduce redundant closings with either a one-time or a two-time close. With our bank, there's very little difference, literally in the hundreds of dollars difference that I might steer you towards at any given time, depending on where rates are and where we expect rates to go. But as you're budgeting, once you're pre-approved for maybe your worst case scenario, your high end of pricing, we're gonna have you add in a contingency budget based on whether it's a fixed or a cost plus contract. The money, again, is in your control, and when you're done with construction, the goal the loan programs, if you've gotten with the right banks, don't require you to pay a bunch of fees to get into a conventional loan. That's how ours work. So if you have any questions, again, on the basic financing for a one or two time close, hopefully this helps, but I'll go into some other things in these other videos. So again, if you just click and subscribe, I appreciate it. And then you'll have access to some other information. My contact information will be down in the section below, the description below. So again, I'm the Cowtownbanker. Thanks for your time.